I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Recently, Gary Rollo from the Montgomery Small Companies Fund wrote a blog post about NextDC. He made the point that despite tremendously positive long-term demand dynamics for cloud computing and storage, and despite falling interest rates, NextDC's share price has underperformed the market and its peers. Indeed, closer examination reveals that NextDC's share price is unchanged over almost 2 years. In other words, it's where it was 2 years ago. But as you can imagine, for a value investor, a flat share price over 2 years can be extremely positive. You see, 2 years ago in 2017, the company reported revenue of $126 million. 2 years later in 2019, the company's reported revenue of $179.3 million, in other words, up 42% on the 2017 result. Gary also pointed out that the lack of capacity to sell when demand has surged meant a slowdown in earnings momentum for NextDC, and delays to the commissioning of the company's second Sydney data centre created further delays to the realisation of those earnings. When the market treats that which is temporary as permanent, value investors have the opportunity to invest in quality at what may be seen in the future to be a mouth-watering price. Typically, short-term investors don't like heavy capital expenditure because fixed asset turnover declines until the revenue from the project starts to come through. And I've seen this many times before, and the market's impatience can be to the value investor's advantage. As Charlie Munger once said, you should seek businesses that just drown in money if they simply pause for breath. NextDC at the moment is just not pausing for breath. Well, not yet. And data centres will experience steady growth in demand for decades as businesses opt for cloud computing to offload the pressure they experience from rising volumes of data and in-house storage. In Australia, the sector has grown by 12.2% annually for the past 5 years, according to the latest research from IBISWorld. Of course, it's true that NextDC doesn't have this market all to itself, and the advent of competition has also rattled short-term investors, contributing to the share price underperformance. But the reaction to more recent competition seems irrational, given the competition has always been there. Recently, one broker downgraded NextDC to neutral amid concerns that the emergence of AirTrunk as a competitor could put pressure on wholesale pricing. They pointed to AirTrunk's purchase of a site in Sydney's Lane Cove and its proximity to the CBD. But we reckon the site is inferior for a variety of reasons, and that NextDC probably thinks so too. And if the rumours are true, AirTrunk might have the for sale sign out, which could put its rapid expansion in a very different light. In addition to AirTrunk, other competitors include the NASDAQ-listed Equinix, which this month opened its 8th data centre and its 5th in Sydney. And by that I mean to point out that NextDC's growth has been occurring even in the presence of established competition. One needs to remember the scale of the thematic, and that there are already 16 operating data centres in Australia. Competition, in other words, is nothing new. Analysts could be jumping at shadows, and the flat share price for 2 years could be an example of long-term value being in plain sight. In terms of other competitors, there's Mactel and Digital Realty, as well as Iron Mountain. And with Digital Realty and Iron Mountain scooping up data centres and operators globally, NextDC could be a takeover target. Of course, that's speculation rather than value investing. NextDC appears to be a long-term infrastructure play that investors should be viewing with a telescope rather than a microscope. To understand the opportunity better, one should be thinking long-term, as we do here at Montgomery. With that, I look forward to talking to you again next week, and in the meantime, follow us on Facebook and Twitter.